I want you to close your eyes for just a second and imagine an arms race.
Okay.
But, instead of submarines or fighter jets, the weapons are these sprawling, like football field-sized data centers. And the ammunition they're stockpiling is custom silicon.
Right.
And the price tag just to sit at the negotiation table, hundreds of billions of dollars.
Yeah, I mean, it is a completely different scale of corporate warfare. We are talking about capital expenditures that literally rival the gross domestic product of entire nations, and all of that deployed in the span of a single fiscal year.
It's wild. And, well, before we get into the trenches of this financial battlefield, I do need to state right up front, this analysis is for entertainment purposes only. Consult a professional for your specific case.
Exactly. Always do your own research.
Right. Okay, so with that out of the way, here is our mission for today's deep dive. We are looking at 4 undisputed tech titans that are, honestly, single-handedly driving the 2026 market. We're talking Amazon, Microsoft, NVIDIA, and Meta.
And to figure out what is actually happening inside these companies, we aren't just, skimming the headlines. We've pulled together this massive, towering stack of Q4 and Q2 earnings reports, detailed hedge fund presentations.
Including those strategy notes from Pershing Square, right?
Yes, exactly. Plus the latest analyst teardowns from Morningstar, Zacks, and TIKR.
So why should you care about this? I mean, whether you're managing a retirement portfolio or prepping for a strategy meeting in the tech space, or just, trying to understand where the global economy is heading over the next decade, you really need to pay attention to these 4 companies.
Because their capital expenditures aren't just line items on a spreadsheet anymore.
Yeah.
They are literally building the physical infrastructure for the future of human-computer interaction.
Yeah. So let's start by looking at the baseline of this whole AI infrastructure boom, which means looking at the 2 undisputed heavyweights of cloud computing, right? Microsoft and Amazon.
Right. Looking at the cloud is really the only way to understand the architecture of this boom. And right now, Microsoft is positioned as this steady, unstoppable juggernaut.
Yeah, they really are.
If we look at their business landscape for Q2 of fiscal year 2026, they just posted $75.25 billion in revenue.
Wow.
But the number that analysts are completely obsessing over is their operating margin. It sits at an astonishing 46.6%.
Wait, okay, before we move into the AI-specific numbers, let's just ground that for a second.
Right.
Almost half of every single dollar Microsoft brings in is operating profit.
Yeah, half.
For a company operating at a $75 billion quarterly scale, how is a 46% margin even physically possible? I mean, doesn't the sheer friction of running a global business usually drag that down?
Usually, yes, absolutely. But Microsoft has successfully transitioned, well, almost its entire customer base into high-margin, recurring software subscriptions.
Right. You don't buy an Office disk anymore.
Exactly. You pay every single month. But the real driver here, like the standout metric of the quarter, is Azure, their cloud platform. Azure hit 39% growth.
Which is huge.
And that growth is being heavily driven by integrating OpenAI into every single layer of their enterprise stack.
And what does that integration actually look like on the ground, like day to day?
Well, it means that, say, a mid-level manager at a logistics company can open Excel, and instead of writing all these complex formulas, they just type in plain English, show me the supply chain bottlenecks in the Midwest region.
Oh, wow.
And the AI agent just queries millions of rows of Azure-hosted data instantly. Microsoft is basically selling the picks, the shovels, and the maps to the gold mine.
Which naturally leads us to how Wall Street is valuing them right now. So Microsoft is currently trading around $513 a share with a price to earnings, or PE ratio, of roughly 38.4x.
Yeah, 38.4.
For our listeners who don't look at valuation multiples all day, what is that 38 PE telling us compared to their historical average?
Well, a PE of 38 means investors are willing to pay $38 for every $1 of Microsoft's earnings. That is a premium.
Okay.
Because their 5-year average has typically hovered closer to the low 30s. So the market is pricing in a lot of future perfection. And to see if that price makes sense, analysts at firms like Morningstar, they run what's called a 10-year discounted cash flow analysis, or DCF.
Okay, let's unpack the mechanics of that DCF model, because that really is the backbone of how hedge funds decide if a stock is cheap or expensive. How are they running the math on Microsoft?
Right. So the premise of a DCF is that a company is only worth the cash it can generate in the future, discounted back to today's dollars.
Makes sense.
For Microsoft, analysts are taking a really robust free cash flow base, let's say an estimated $80 billion for the year.
Okay, 80 billion base.
Yeah. Then they model a 9% growth expectation every year for the next 10 years. Then they apply a 2.5% terminal growth rate, which basically assumes the company grows at roughly the pace of global inflation forever after year 10.
Right, the forever growth rate.
Exactly. And finally, they use a 10% discount rate to account for the risk of the investment and the time value of money.
Okay, so when you crunch all those specific numbers,
Yeah.
the 9% growth, the 10% discount rate, the 2.5% terminal rate, what intrinsic value does the model spit out?
That exact model generates an intrinsic value of roughly $600 per share.
Wow. Okay, and since Microsoft is currently trading around $513, Morningstar and Zacks maintain a strong buy verdict because the stock is trading at a decent discount to its calculated intrinsic value.
Exactly. They are printing cash, and Wall Street loves the math.
But, Microsoft's 39% cloud growth means they are actively narrowing the market share gap with their biggest rival.
Which brings us to the other side of the cloud war, Amazon.
Right, Amazon.
Their AWS cloud is growing at 24%. That is a 13-quarter high, which is phenomenal, but it is still trailing Azure. And looking through our sources, Amazon's overall business right now is this fascinating tale of two absolute extremes. It really is. The contrast within Amazon's own business landscape is completely unprecedented. On one hand, you have their retail division achieving levels of efficiency we just haven't seen before.
Right.
Through intense regionalization and robotics, they actually pushed their North American retail margins up to 9%.
Which is crazy. Because historically, retail is this razor-thin, like 2 to 3% margin game. 9% is a structural breakthrough.
Oh, absolutely.
I read the breakdown on that regionalization strategy, and it is brilliant. Instead of having a national network where a package might fly from a warehouse in California all the way to a doorstep in New York, they broke the country into 8 completely self-sufficient regions.
Right.
So the item you order is already in your region.
Yeah.
And you combine that with their new fully autonomous Proteus robots, which don't just follow those magnetic lines on a floor anymore, but actively navigate around human workers to sort packages. And the cost savings are monumental.
Yeah, and that retail efficiency is funding the other extreme of the business. Amazon just announced a $200 billion capital expenditure plan for 2026.
$200 billion.
$200 billion. It is earmarked primarily for AI infrastructure, their custom silicon called Trainium, and low Earth orbit satellites.
This is where I have to admit some confusion, or at least play devil's advocate for a second. Because they are spending so aggressively, Amazon's free cash flow has been compressed all the way down to $11.2 billion.
Yeah, it's a huge drop.
It feels like Amazon's retail side is this finely tuned restaurant where the kitchen is operating so efficiently that instead of taking the profits, the owners are quietly buying up all the real estate on the block to build a competing tech park next door.
That's a great way to put it.
Right. So is Amazon's $200 billion spend a masterstroke to catch up to Azure? Or a historic misallocation of capital that's just going to ruin their cash flow for years?
Well, I mean, it looks like a mistake if you only look at the 2026 calendar year. And Wall Street generally has a notoriously short attention span. They see free cash flow drop to $11.2 billion, and they panic.
Sure.
But Andy Jassy, Amazon's CEO, is playing a 10-year game. Amazon recognizes that the bottleneck for AI isn't customer demand, it is physical capacity. They literally could not build data centers fast enough in 2025.
They have to spend it.
Exactly. And by designing their own Trainium chips, they are trying to break their reliance on outside suppliers. If they do not spend this $200 billion right now, they risk letting Microsoft just run away with the enterprise AI market completely.
Okay, so how does that aggressive spending reflect in their valuation multiples?
Currently, Amazon is trading at a PE of about 27.8x to 29.5x.
Okay.
That is significantly lower than Microsoft's 38x and well below Amazon's own 5-year average, which, often spiked above 50x in the past. Pershing Square explicitly noted in their presentation that they bought Amazon at an all-time low valuation relative to the S&P 500.
Let's run that exact same 10-year DCF model we use for Microsoft. If we use a 9% growth expectation, a 10% discount rate, and a 2.5% terminal growth rate, how do analysts find upside when the current free cash flow base is only $11.2 billion?
That is the trick. Analysts do not use the depressed $11.2 billion figure for their DCF base.
Oh, they don't.
No, they use a normalized free cash flow base, basically estimating what the cash flow would be if Amazon weren't temporarily sinking $200 billion into data centers.
Huh.
So when you run the DCF on a normalized base of around $50 billion, applying that 9% growth and 10% discount rate, the intrinsic value lands around $278 to $280 a share.
Got it. And with the stock currently trading significantly lower than that, the analyst consensus is a resounding strong buy.
Exactly.
Okay, so Amazon is sacrificing its current cash flow to spend hundreds of billions on infrastructure.
Yeah.
But you can't just, set fire to $200 billion. You have to physically buy something with it. And right now, there is really only one store they are shopping at.
Yeah.
Which perfectly sets up our next company.
NVIDIA, the undisputed kingmaker of the hardware world.
Yes. And the numbers coming out of NVIDIA's FY26 results actually challenged my comprehension of corporate finance. Like, they reported $215.9 billion in revenue. That's up 65% year over year.
Yeah.
But the figure that requires real scrutiny is their cash generation. $97 billion in free cash flow. While Amazon is compressing its cash flow to build the physical buildings, NVIDIA is just hoarding mountains of the actual cash.
And their business landscape is defined by one vital metric, a 71.1% gross margin.
Which is unbelievable.
I mean, they are the primary arms dealer in this global conflict. Every single hyperscaler, Amazon, Microsoft, Google, Meta, is waiting in line to buy their silicon.
I need you to explain the mechanics of that 71% margin, because NVIDIA builds physical things. They build highly complex, resource-intensive hardware. And hardware companies usually have terrible margins because of manufacturing costs, shipping, and supply chain constraints. How on earth does a hardware company achieve software-like margins of 71%?
Well, because NVIDIA isn't just selling a piece of metal and silicon, they are selling an ecosystem.
What do you mean?
They developed a software layer called CUDA, which developers use to communicate with the graphics processing units. For the last 15 years, almost every AI researcher learned to program using CUDA.
Oh, wow.
So if a competitor builds a chip that is just as fast as NVIDIA's, it doesn't really matter because the competitor's chip doesn't run CUDA. NVIDIA's margin comes from this impenetrable software moat. Customers will pay any price because switching costs are just too high.
Okay, so let's talk about that price, specifically the stock price. NVIDIA is trading around $174 with a PE ratio of 35.86x. And the forecasts from Zacks project that NVIDIA's revenue will surge another 71% this year, pushing them to nearly $370 billion in revenue.
Right. And if we look at that PE of 35.86x, it is actually quite reasonable compared to its own 5-year average, which, frequently skyrocketed past 60x or 70x during the initial hype cycle. The earnings have finally caught up to the price.
So what happens when we run the 10-year DCF model on NVIDIA?
We take that staggering $97 billion free cash flow base. We plug in the standard 9% growth expectation over 10 years, the 2.5% terminal growth rate, and the 10% discount rate.
And the results?
The math yields an intrinsic value ranging from $265 to $325 per share. So comparing that intrinsic value to the current $174 stock price, Wall Street is nearly unanimous. NVIDIA is a strong buy.
Now, I do want to challenge this seemingly perfect narrative for a second. With a PE near 36x and revenues already in the hundreds of billions, can a company actually sustain a projected 71% growth rate next year?
It's a valid question.
Right. Because at a certain point, the laws of physics, electricity grids, and raw material supply chains have to cap this growth. Is the market pricing in absolute perfection while ignoring the fact that Amazon is actively trying to replace NVIDIA with its own Trainium chips?
Well, the risk of hyperscalers building their own custom silicon is real, but it is a very slow process. Furthermore, NVIDIA is pivoting. They are pushing into a concept they call AI factories.
AI factories.
Yeah. To sustain that 71% growth, they are no longer relying solely on tech companies. They are expanding their customer base to sovereign nations building their own supercomputers for national defense, massive healthcare conglomerates running drug discovery models, and automotive giants simulating self-driving data.
I see.
The sheer global demand for inference computing, the electrical power required just to generate an answer every time someone uses an AI model, is keeping the engine roaring.
Okay, so we've covered the cloud providers hosting the models and the hardware titan building the chips. Let's look at where this technology actually meets the everyday user. Meta.
Yes.
Meta.
They represent the consumer application of this AI infrastructure. But looking at our sources, Meta proves that having the most sophisticated AI technology in the world does not grant you immunity from the friction of the legal system.
It certainly does not. But let's look at Meta's operational business landscape first, because the underlying engine is performing incredibly well. In Q4 2025, their revenue hit $59.9 billion.
That's a 24% increase, right?
Exactly. And the catalyst for that growth is their AI-driven ad targeting.
The sources mention that Meta introduced a single product ranking change that created a 7% lift in organic views on Facebook. How does an AI tweak actually accomplish a 7% jump in a mature platform with billions of users?
It basically comes down to predictive mechanics. Previously, ad targeting relied heavily on demographics, age, location, interests, things like that.
Sure.
The new AI infrastructure analyzes behavioral micro-patterns. It measures the exact millisecond hesitation in your scroll speed to predict what type of content will keep you on the platform longer.
That is slightly terrifying, but amazing.
Yeah, by perfectly optimizing the infinite scroll, user engagement rises, which allows Meta to charge advertisers significantly higher premiums because the conversion rates are so guaranteed.
And to maintain that algorithmic edge, they're opening the checkbook just like Amazon. They're guiding for $115 to $135 billion in 2026 capital expenditures.
Right.
But here is the friction we mentioned. They recently suffered a landmark $375 million loss in a New Mexico child safety trial. And even more critically, they faced a Los Angeles social media addiction case that successfully bypassed Section 230 protections.
Yes, and we really need to unpack the mechanics of that legal ruling impartially, purely based on the analyst's notes from TIKR.
Yeah, let's do that.
Section 230 of the Communications Decency Act has traditionally shielded tech platforms from liability, essentially stating they are not legally responsible for the content their users post. If a user posts something harmful, the user is liable, not the platform.
Right. So how did the plaintiffs in Los Angeles get around a federal law that has protected the internet for decades?
Well, by changing the target. The plaintiffs argued that they were not suing over specific third-party content. They argued that the design of the platform itself, the algorithmic force-feeding of content, the variable reward schedules, the infinite scroll, was inherently defective and addictive.
Oh, wow.
Yeah. By attacking the software design rather than the user content, the courts allowed the case to bypass Section 230 protections.
And the market reaction to that legal theory was swift. I mean, those court losses caused an 8% plunge in Meta stock, dropping it to around $592.
Yep.
When you combine this looming existential legal cloud with their $135 billion CapEx budget, Meta is currently trading at a PE multiple of just 21.8x. That is sharply lower than its 5-year average and, incredibly cheap compared to Microsoft's 38x.
But despite the very real legal drama, analysts overwhelmingly maintain a positive outlook. Let's run Meta through our 10-year DCF model.
Okay, let's hear the numbers.
Meta generated roughly $115 billion in operating cash flow in 2025. If we estimate a normalized free cash flow base of around $50 billion, accounting for their massive capital expenditures, and apply our 9% growth expectation, 2.5% terminal growth, and 10% discount rate,
What's the target?
the model generates an intrinsic value with a mean price target of $863.63.
So with the stock at $592, an $863 target implies roughly a 45% upside.
Exactly.
So my question is this. Is Wall Street double-counting Meta's risk? Are investors overly punishing the stock for both the heavy infrastructure spending and the legal vulnerabilities, creating an artificial discount?
Analysts argue that the risk is absolutely being double-counted. Wall Street is doing the math on the lawsuits. The $375 million New Mexico penalty represents less than 2 days of Meta's 2025 operating income.
Wow.
2 days. Right. Wall Street firmly believes that the core AI ad engine is compounding so rapidly that it will simply power right through the legal noise. The improvements in ad conversions are generating revenue vastly faster than the courts are generating fines.
But if Section 230 protections actually do fall across the board based on this platform design legal theory, does Meta's entire business model fracture?
Well, If Section 230 falls, it fundamentally alters the liability math for every tech company on Earth, not just Meta.
True.
But our sources suggest that even in a worst-case legal scenario, Meta's unmatched cash generation gives them a buffer none of their smaller competitors have. They can afford to fight the protracted legal battles, absorb the fines, alter their algorithms to comply with new regulations, and still outspend almost anyone else on AI research.
All right, well, we have covered a vast amount of financial territory today, from server racks to Supreme Courts. Let's distill the final verdict for you, the listener.
Yeah, let's sum it up.
Based on the rigorous DCF modeling across Morningstar, Zacks, and TIKR, comparing intrinsic value to current stock prices, the final analyst verdict for Amazon, Microsoft, NVIDIA, and Meta remains a resounding buy.
The consensus is very clear. Wall Street firmly believes that the long-term upside of dominating the physical infrastructure of the AI economy far outweighs the short-term anxieties over margin compressions, legal fines, or $200 billion capex budgets.
Right.
The market is aggressively valuing the future over the friction of the present.
And this is precisely why understanding these mechanics matters to you. These four companies are laying the concrete for the digital economy of the 2030s.
Absolutely.
If you are adjusting your portfolio, knowing that the market currently favors long-term infrastructure moats over short-term free cash flow is a vital lens. If you are navigating a modern workplace, understanding how Microsoft and Amazon are deploying enterprise AI agents gives you a strategic roadmap for how your own industry will operate in the next 5 years.
They are essentially building the transcontinental railroad of the 21st century.
Yes. But, I want to leave you with a lingering provocative thought, something that wasn't explicitly modeled in those 10-year discounted cash flow spreadsheets.
Okay, what is it?
Right now, these tech giants are heavily funding each other's growth. Meta and Microsoft are spending billions buying NVIDIA's silicon. Amazon is buying NVIDIA chips while actively building their own. They are all purchasing each other's cloud space and hardware to train increasingly complex models.
It functions as a highly insulated, closed-loop economy at the very pinnacle of the tech sector.
Exactly. So here is the question you need to mull over as you watch these stocks move over the next few months.
Ah.
If everyday end consumers and non-tech enterprises don't adopt AI tools fast enough to actually generate the trillions in revenue required to justify these capital expenditures, who is left holding the bag when the music stops?
That is the big question.
If the data centers are built, the silicon ammunition is spent, but the real-world demand stalls. How does this arms race end?